throughout our negotiations with the United States on a new trade and security relationship.
On September 1st, Canada will lift many of its retaliatory tariffs on U.S. goods. Headlines say this will unlock markets, but what does it actually change for investors, exporters, and families? Today, we cut through the noise with data, so you know what's signal and what's spin. Ottawa is scrapping a chunk of counter tariffs to align with exemptions under the USMCA trade pact. The move is calibrated, not total. Tariffs on steel, aluminum, and autos stay in place while negotiations continue. Translation: cross-border trade in most categories faces less friction, but the most strategic, politically sensitive sectors remain gated. Two reasons. First, de-escalation buys negotiating runway ahead of the 2026 USMCA review. Second, uncertainty has been taxing the real economy more than the tariffs themselves. Firms were delaying orders, hedge costs were rising, and supply chains were nursing an uncertainty premium. Removing that premium can be a bigger immediate boost than a few percentage points of tariff relief. A Reuters poll this week projects the S&P TSX Composite to rise roughly 2.3% into year-end, with a credible path toward the 30,000 level in 2026. That isn't just optimism, it reflects two tailwinds the index is uniquely levered to. One, a lighter policy overhang on North American trade, and two, rate cut optionality from the Bank of Canada as inflation hovers near target. Remember, energy and materials make up a large slice of the TSX. When trade visibility improves and the Canadian dollar stabilizes, cash flows in those sectors screen better on a 12 to 18-month view. Valuation. The policy uncertainty discount narrows first. Multiple expansion shows up before earnings do. FX channel. A steadier loonie lowers imported input costs for manufacturers and retailers. Margins firm up at the edges. CapEx timing. With fewer tariff surprises, CFOs can greenlight inventory and equipment cycles that were stuck in neutral. Rate path. If volatility in goods prices keeps easing, the BOC has room to stay or ease, lowering hurdle rates for projects that didn't pencil at last year's financing costs. Likely winners: rail and trucking corridors tied to USMCA lanes, agriculture and machinery exporters, consumer names with heavy US sourcing and thin margins. On watch: steel and aluminum value chains, plus auto and parts. Tariffs remain, so pricing power stays chalky. Quiet beneficiary: Canadian banks. Less trade friction and a gently easier rate path reduce credit risk at the margin, especially in commercial lending. Not a free lunch. If the U.S. keeps selective tariffs or probes active, supply chains will still face localized shocks. Watch lead times and backlog data. Index level: the TSX recently flirted with record highs before consolidating. The forward path markets are handicapping is modest, not euphoric, consistent with a world where tariffs de-stress but growth stays mid-cycle. Inflation mix. Headline near target with sticky core components reminds us the BOC will remain data dependent. Don't build a thesis that needs rapid fire cuts. 1. The effective date and the fine print. Does USMCA aligned cover your product code? 2. Any reciprocal moves from Washington. The rhetoric can change faster than the regulation. 3. September-October data. Export volumes, PMI new orders, rail car loads. If they inflect, the thesis is working. 4. USMCA 2026 review milestones. This is a pre-game, not the main event. So, is Canada's tariff reset a catalyst? Yes, but a measured one. The bigger win is scrubbing uncertainty out of pricing models and boardrooms. If you want more data-driven briefings like this, subscribe and tell me which sector you want me to model next: rails, banks, or industrials.